Precious metals, going back to what the Fed is doing, I think precious metals prices are going to go up because
from a monetary
near term, because the Fed is making mistake after mistake after mistake, devaluing the dollar. I think that puts people in fear of being in fiat currency. So I think people move into precious metals. So if I had to say our view on gold, silver, precious metals, etc., I would say it's bullish.
Yeah.
The Fed is the problem. They are the fundamental and primary problem. Clearly, Gary, it's not supply chains, right? Because if it was supply chains, which every politician was saying, right, when supply chains corrected, which they have, prices would have corrected. They haven't. Prices have just gone straight up. So clearly, it wasn't supply chain. This is a Fed problem, and it needs to be nipped in the bud before, like Munger said, inflation. The only thing being worse, nuclear war. So what does that mean? Nations fall on inflation. We need to get this problem solved.
Yeah, I hear you. And it's kind of like squirrel, look over there, but not over here. So looking back on history, the Fed had to raise rates in March and May of 2000 to pop the dot-com bubble. If inflation continues to metastasize as it has and get higher and higher, and the Fed has to hike rates, as you're saying, instead of lowering them, do you expect a similar impact on the markets to 2000? And what do you see for the economy also if that plays out?
Right. So right now the market is pricing in 4 rate cuts, right? If they have to actually hike rates this year, which I think they will, I don't know if I think they should, I should say. I don't know if they will. I mean, you'll have an explosion in yields, 200 basis points move higher in yields. If that happens, right, the point is, the reason why the Fed shouldn't make these mistakes is because when they eventually have to right the wrong, the move they have to make is so much exponentially more aggressive that the effect on markets is so profound and immediate. It's like you're busting a bubble, right? They're blowing a bubble and then they're going to have to bust it, right? Pop the bubble, if you will. So I think stocks will implode. I think temporarily the U.S. economy will enter a recession because, credit growth will slow significantly. Right now, credit growth is still strong. So I think that would be very bad. But I think that's the position they've put themselves in. I think they've already made the mistakes, right? So I think that they're going to have to do that. And
is that 2024? Do you see that?
I think that's a 2024 dynamic. Again, going back to what I think the stock market does, well, we don't have to talk about that. Let's stay on Fed and rates. But yeah, I think that's a 2024 dynamic. And the issue is inflation is inflecting higher. That's the big problem, right? And again, for those who say, oh, it's an election year, they can do whatever they want. No, the reason why the Democrats are in such, or I should say Biden has such a record low approval rating is because people are frustrated about inflation. So if you have a reversion, an inflection higher in inflation, which I think we're already seeing, people are going to be more upset. They're going to want any whoever's the different candidate, that's who they're going to go with because they can't afford to live life. So I think that, them continuing to push the stock market higher by methods that are driving inflation higher, I think is very dangerous. And I think very negative. So I think they'll have to nip that in the bud if they want to win.
So there's been a couple of comments here where I feel like it's hard to trust the Fed. A few months before the 2008 great financial crisis implosion, then Fed Chairman Ben Bernanke publicly announced in a major speech in front of hundreds of economists that he didn't even see a recession coming and everything looked okay.
Right.
Either he didn't understand the situation, he didn't have the information to see what lied ahead, or he was deceiving the public. I have no idea what the truth is. But should we believe what the Fed is telling us now and anticipate this soft landing as they're currently indicating? And if we're not to believe them, should we be expecting the complete opposite?
Yeah, I think terms like soft landing and hard landing, it's ridiculous. I think the economy is path dependent. And for instance, if tomorrow the 10-year Treasury, exploded 200 basis points higher, everybody who's saying soft landing is effectively wrong. So my point is, I don't think you can know when you say soft or hard landing, you're basically saying, I know the future, and none of us know that. You have to look at what happens. So I think using those terms is useless. I think what happens is because the same things they did to inflect inflation higher initially, they're doing now, but exponentially more so in a lot of cases. I think that inflation expectations are going to go higher. I think rates are going to go higher. And I think that as a result of that, you're going to have a significant sell off in what I see as overvalued stocks, layoffs, and thus a recession. And I think that whether you want to call that a hard landing or whatever you want to call it, I think that's the likely path of how things unfold. Am I 100% certain? Of course not. Again, I'm not clairvoyant, but I think that all data points are pointing to that direction. And the crazy thing, Gary, is like when you see these economists on the financial news outlets, it's like they're just they say, oh, there's going to be rate cuts. It's just they're not talking about the data points. They're not focused on the actual data, and then they cherry pick these numbers that mean nothing. They're like, oh, forget about annualized CPI. Let's look at the 3 month, and they'll move it to 4 months, 6 months, And so the point is, it's like the people who are supposed to be informing the public of what's coming are saying the exact opposite of what's happening. Yeah. So I think that the reality that unfolds this year is going to shock some people, and that's what's scary.
Yeah, I've been feeling for several years like they're leading us to a meat grinder. And if you're not in the know, then you're going to be surprised when you get there. And I think it's so important that this information gets democratized and spread out as quickly, as far and wide as possible so that people can be prepared and not just be led by a bullnose into something terrible that's coming.
Right. Yeah. Gary, can I say one thing? I messed up a little bit. I want to talk about what I think the Fed needs to do. Here's what I think the Fed needs to do. I think they need to stop saying policy is restrictive because clearly it's not. Evidenced by what we saw last year, despite no rate cuts and the 10-year averaging over 4% for the second half and even hitting 5%. They need to remove all cut intentions for 2024 with some dot plots actually looking for hikes as the next move. They need to raise the neutral rate. And if they do those things I mentioned, I think the market will be hit over the head and, we'll get serious about going down to 2% inflation, not zero, but I think they need to do those things.
Okay.
But right now, I don't think they understand how the economy works when deficits are this large. So I think that's why they're making mistake after mistake.
So there's been a constant theme throughout this discussion today, a thread about the consumer and about the consumer being on the wrong end of the stick here, that they're breaking us.
I'm a consumer.
Yeah. And so, I'm curious, where's the brick wall? Where's the breaking point? Where's the cliff for the consumer? Does it correlate with your anticipated recession sometime, middle to end of 24? Is that when finally they'll hit the brick wall?
Right. So again, let's go back to the Russell 2000, right? With earnings being down significantly. So the backbone of America, you could argue, is in a recession or close to it, the small companies. And clearly that Main Street will bleed to Wall Street, the big companies, the Mag 7, if you will. So what will happen is inevitably those companies will start firing people or cutting jobs to basically, pad their losses. And when we have a real jobs recession, which by the way, we're nowhere near, right? We're adding 350,000 jobs a month, whereas the replacement rate is 50 to 90. We need to get down to 50 to 90 to be concerned. We're nowhere near there. But that's when I think things will really get scary here, because you'll have a bunch of people who are unemployed with prices rising and the stock market rising every day. And I think people will get, very upset because they'll see Wall Street, having champagne parties every day. Meanwhile, they can't feed their kids. That's a very nasty equation / calculation, if you will. Sorry, go ahead.
Yeah, no, I've got two questions on that. What depth of unemployment level are you seeing from here? 3.7 up to, is it a garden variety? Are we going to get up to, 5.5, 6? Are you thinking higher? And are you feeling that the probability is increasing for massive social unrest to occur?
So with respect to the number, I can't predict an exact number. I know a lot of people like to do that. I can't. Let's just say it's going to go significantly higher. And yeah, I think there will be social unrest. And I don't necessarily, because the masses aren't educated on all these topics we're talking about, I don't think it's necessarily going to be people saying, I'm mad because of inflation. It may be something like George Floyd or some other social. People may say we're tired of them. We're tired of immigration. They're going to use some factor that isn't directly related to their frustrations to protests and for us to see social unrest. But the fundamental reason is going to be, in James Carville's words, the economy's stupid. And again, the Fed policy that's in place clearly is not restrictive and it's inflationary. Yeah. And with them talking rate cuts, they're talking down. They're basically loosening financial conditions with their words, right? Yeah. And they're literally saying this every day. So they're actually talking up inflation almost on a daily basis, which is reckless and scary given the amount of Americans that own guns.
Yeah. I hear your point loud and clear.
There was this billionaire in Germany, and he was asked a question on TV, and they said, your taxes are going up, a lot. And he's like, the reporter said taxes are way, way lower in the U.S. And he said, I'd rather live in an economy where I have to pay higher taxes and the masses are happy than for me to be very rich in an economy where the masses are unhappy. Yeah. He's like, because in an economy where the masses are unhappy, my money means nothing. I think people have lost sight of that in the U.S.
Wow, that's powerful. One last question on the debt and Fed. I've heard reports of almost $10 trillion in 2024 alone is going to be both rolled over and with the deficit spending. Do you expect there to be enough buyers of the debt, or do you believe the Fed's going to have to monetize it? And if so, what does that mean for inflation and purchasing power, et cetera?
Again, going back to that. So remember, a lot of the debt issuance that Janet Yellen did in Q4 and in Q1 was short-term in nature. So you're talking about T-bills, right? And that's easily funded out of the reverse repo account. But hold on, I just want to cite something here. 1 second. So think about this, right? So that was funded out of T-bills, right? They just did a 20-year bond auction on Wednesday. It was a disaster. So my point is, why buy treasuries or any long duration debt when deficits are growing 7% a year and nominal GDP is above 5% with rates, sub 5%, right? Talking 4% rates, right? If the fiscal change is nothing, why would anyone want to buy long duration debt for anything less than 6 to 7%? It just doesn't make sense. So to your question, I think that barring the Fed reverting to QE, which would cause an explosion in inflation and really cause big problems, I think that there's going to be a Liz Truss UK-like event in the U.S. this year with all this debt, $3 trillion, that Janet Yellen plans to issue. Already, we're seeing a massive pushback, a record tell on the 20-year bond auction on Wednesday. Indirect offerings, foreign demand collapsing to just around 50%. That's unheard of. There's a big problem brewing, and everybody's just looking over it because Nvidia's stock, has gone gangbusters. It's amazing that what everybody's doing, and we think there's a big problem. So to answer your question, I think there's going to be a pushback. I think yields are going to shoot higher, and I think they're going to have to potentially scale back all these fiscal spending plans.
Yeah, it just seems like so many things are going to be coming to a head here this year. I want to steer us over to precious metals in the last moments we have. How are you?
I thought that's what we were going to talk about.
How are you viewing the precious metals here in 24? And are you bullish? Are you bearish? Are you neutral? How are you positioning?
This is a great topic. I could talk about this for hours. Let me just say this: China is roughly 50% of the world's still consumption and still demand, right? The U.S. is 4%, okay? China is a big percentage of all commodity demand and output, right? China is an utter disaster. They actually need to weaken the renminbi to allow the economy to heal. But they're afraid to do this for two reasons. One, if they weaken the renminbi, it would cause social unrest. And the reason is because if you look at China's GDP per capita, it's quite low versus the rest of the world. So if they weaken the renminbi, you're going to have inflation in China and you're going to have social unrest. That's one reason. The other reason is because the government is concerned that if you weaken the renminbi, there's going to be money leaving China, right? And once that money leaves China, the government's concerned they're not going to be able to get it back in, right? So what they're doing is instead of weakening the RMB, they're implementing policies to keep it inflated at current levels. And I think what that's going to cause is similar to what we saw in Japan. You know, 10, where you had the 10 years, a decade lost of just basically horrible economic conditions for 10 years. But the problem is, if you go back to when Japan made the same mistake, it was a much richer economy if you look at GDP per capita than China is. So I think by not letting the currency weaken, again, they're setting themselves up for a lost decade. And I think what that means for commodities writ large is you're going to have a significant deflation in steel, iron ore, coal, copper, et cetera, prices. And inevitably, China's producers are going to have to export that deflation to the rest of the world. So I think we're entering into a commodity, recession driven by China that I think a lot of people aren't prepared for. And you're going to see this reflected in companies like Caterpillar, URI, U.S. Steel, Cleveland Cliffs, et cetera, that I don't think are currently reflected in the stocks. So I think we need to get through this period, which I think could be 1 to 2 years, but I think it's going to result in China shipping cheaper commodities to the rest of the world. And given they're the bulk of the world's production and demand, I think that's going to have pretty profound impacts on the prices of commodities.
And so where do you see the precious metals fitting in there?
Precious metals, going back to what the Fed is doing, I think precious metals prices are going to go up because
from a monetary
near term, because the Fed is making mistake after mistake after mistake, devaluing the dollar. I think that puts people in fear of being in fiat currency. So I think people move into precious metals. So if I had to say our view on gold, silver, precious metals, et cetera, I would say it's bullish.
Okay. So I recently had another Wall Street veteran on the show that you likely know. His name is Jeffrey Fouvry. I had him on about a month ago, and he recently wrote this. That betting on miners is basically the same as betting, and we're talking precious metals miners, is basically the same as betting that some market participant will stop their superstitious buying of U.S. debt in the face of obvious funding problems, exemplified by yet another botched auction. At that point, both the currency and the U.S. Treasury experience weakness. This is an environment where the currency weakness devaluation could indeed outpace the costs that the miners bear, and hence a large bounce in the miners would ensue. He then went on to speak on cracks and divergence between the U.S. Treasury and the CCY, and that Stanley Druckenmiller recently bought large gold miners, Barrick Gold and Newmont Gold. What are your thoughts on Jeffrey's take of the miners needing a weak currency and a weak U.S. Treasury market, and that it looks more probable coming up here now that things are actually headed in that very direction?
When you say miners, I'm thinking Rio Tinto, BHP, Fortescue, but I assume you're talking about gold miners, yes?
Yes, gold miners.
Yeah, we'd be buying the gold miners, very simply. It's very simple. You have a Fed that's making mistake after mistake, devaluing the U.S. currency, and a Treasury market that we're now seeing is reaching its limits. Those two dynamics equal buys gold. It's that simple. It's not that simple, but the way I'd explain it to your viewers is if you're afraid of fiat currencies and afraid of Fed mistakes, you don't want to keep your money in those currencies because those currencies are going to devalue. So what you want to do is put your money in precious metals because in times of fiat weakness historically, precious metals have been the way to go with respect to maintaining some degree of value.
Yes. So it sounds like you agree with Jeffrey. Do you see that as a short-term 1 or 2 year play, and then the Fed gets their act together and changes things, or do you see this as more of an early 2000s through 2000 to 2011 gold bull market?
Again, it's path dependent. We'll see what happens. I think the Fed is going to need to fight inflation this year. If the Fed gets their act together and starts talking about rate hikes, and keep in mind, again, over the past few days, you've had a couple of Fed members come out and say, rate cuts, we got to revisit this, maybe not. If their dot plots come out and are significantly different, then you want to fade the miners. If they continue on this path of we're going to do rate cuts this year no matter what, and one of the members, I couldn't believe he said this, the recent inflation data is, quote, noisy. If they continue with this stuff and you continue to get them pushing these meaningless metrics like 3-month moving average CPI, then gold is going to go up. Right now, it's the latter, right? They're going to continue to make mistakes. They're continuing to say they're going to cut rates despite inflation inflecting higher and a number of data points saying the U.S. economy is overheating. So right now, I'd say we're bullish gold.
So before we wrap up here and I ask Gordon our final question, I just want to point everyone over to our Substack. It's free, metalsandminers.substack.com. We post a lot of free content on the consumer, economy, markets, artificial intelligence, individual metals and miners each and every week, keeping what is important top of mind for you. It's all organized in one digital destination. And again, it's free. So go subscribe. All you got to do is put in your email. All right, Gordon, just wrapping up our discussion, I've got a two-part final question for you. What is currently worrying your clients when you have calls with them? And what haven't we spoke about that you want the viewers to know or consider for this year?
Right. So we cover solar, which we think is a great short this year. We cover Tesla, which we think is going to be the greatest short of all time. We think this is the year to short it. We think the steel sector is going to come under pressure because we think that the futures market on HRC prices, this is, U.S. Steel, ticker X, Cleveland Cliffs, ticker CLF. We think the U.S. futures market is way too aggressive, way too optimistic on what HRC prices are going to be later this year, over 100, 800. We think it's going to be closer to 600, 700. So we have a lot of sell ratings, right? So our clients' biggest concern to us is they're like, Gordon, you're telling me that if the RRP continues to drain, which we think it is, in general, stocks are going to go up. And the answer to that is yes, we do believe that. So that's counter to some of our specific stock calls, our stock-specific calls. So that would be one of the concerns our clients have. Again, we think in 2Q, you're going to get a collapse in markets overall from a macro perspective that I think is going to take a lot of steam out of the cells, if you will. The one thing that we didn't talk about that I think we should have, uranium. We're very bullish uranium. We cover Cameco, ticker CCO or CCJ. We were we initiated the stock when I think it was like $12 with like a $30 target. It's like $50 now. We think it's headed to roughly 90. And the story there, it's a long pitch, but essentially,
it's an amazing supply and demand story.
It's supply, and that's what we love. So with Fukushima, you had basically the pendulum goes each ways, right? And the pendulum shifted to a significant deconstruction of uranium supply. And now with people realizing that solar and wind aren't the answer, intermittent peak load forms of power are not the answer. They actually cost more than distributed base load. Uranium, nuclear being the only real form of renewable energy. Governments are going back to that because, they have to. Power is what drives economies. So it's not easy to ramp up capacity. Kazatomprom just came out and said they're going to underproduce. Same thing with Cameco. They're the two major miners. So you just have a massive undersupply. And in addition to that, you have these financial entities, Sprott, coming in and buying up all the availability in the spot market. So it's just a beautiful supply-demand story that we think is going to continue to play out. We belong the uranium space. There's much more to it. We could get into it, but I know we're over time.
Well, Gordon, I want to have you back on soon. And we'll talk about uranium, the miners, the SPUT.
We missed Tesla.
We'll talk about Tesla. We'll talk about
gold. I'm happy
gold.
not to talk Tesla. It's like people look at me as like, all I know is Tesla. It's ridiculous. We covered 21 stocks. So it's not just Tesla.
I want to go. Yeah. I mean, and so there's only so much time for these, interviews, but I want to have you back on soon if you're amenable to that. So Gordon, Absolutely. it's been so great. You've been so generous with your time, your analysis, your ideas. I really appreciate you coming on the Metals and Miners podcast. Can you tell the viewers where they can learn more about your work at GLJ Research and how they can connect with you?
Yeah, just go to our website, GLJResearch.com. If you want to connect with us, I'll have a GLJ Research salesperson reach out. We pride ourselves on our research. I talk about a lot of macro stuff on Twitter, but the reason I do two all-nighters every week is because we're focusing on the company-specific stuff. That's how you really create alpha for your clients. That's how you really make it in the stock market. And that involves reading 10 Qs and Ks. That's old school, but you got to do it. And it involves a lot of work. So that's what we pride ourselves on. I think that's what we don't show on Twitter because that's what we're giving our clients, our paying clients.
Yeah, so everybody go visit him at GLJ Research and also connect with him, Gordon Johnson, on Twitter. He's fantastic. Gordon, thank you so much for your time.
Gary, thanks. Nice to meet you.